welcome on board Anshul Saigal and find out what he's making of the market right now. Anshul, hi, afternoon. Good to have you on the show. Banks, let's discuss exactly that then. Do you think the underperformance is finally coming of age? Because while the Nifty is still, at a fresh all-time high, so are a lot of other individual indexes. Not quite the case with Nifty Bank.
Afternoon, Aisha. Good to be with you. So banks have been a rank underperformer in the last, I'd say, about 6-8 months. While other segments of the market have rallied as they have, banks have really done nothing. And some of that is because banks have been an over-owned space in the last so many years. Because they are about 30 to 35% of the index as a constituent, banks are clearly highly owned by the street. And at this time, even though valuations look reasonable, because of certain headwinds on their operations, banks are not really the favored space. What we have also seen of late is that while in the last 3 years we've seen about 15% credit growth in the system, but if you look at the last 2 fortnights, that credit growth has tapered down to about 13 to 13.5%. And largely on account of deposits in the system being slightly difficult to come by. In this sort of a setup where there is over ownership and that there is systemic deceleration in credit growth, banks are really not being favored by the markets at this time. But in our judgment, it's only a question of time. Given where valuations are, this is a space which will be favored by the street. This is probably one of the few spaces in the market which remains quite reasonably priced at this time. And so let this little bit of a headwind on credit growth go away. And we do believe that this is a space which markets will favor in, say, the next 1 to 2 years. Definitely, the risk reward is favorable.
That's the word coming in as far as some of these financial stocks are concerned. But Nuresh, what's the view on SBI?
The stock has gone sideways overall for the last many weeks, and it topped out on the day of the exit poll. Say from that price point of 900, it has been drifting lower only, as a lot of support around the 750 to 780 mark. At current levels, I'll wait for the price tick above 830 to start looking at it. But for now, it's been a sideways to a downward trend, and continues to be a consolidation. So very similar to what has been happening with the whole banking space.
So that's the view coming in on the banking space. But Kunal, if I can get your view also on this. Financials as a pack, SBI, because as even Gaurav was pointing out, it was fairly sideways before Mr. Khara took over. And last couple of years, that elephant has started to dance. What analogy we use for that one?
Yeah, I think long-term wise, yes, these stocks have done phenomenally well. I remember, I think SBI trading at a point, pre-2020 towards the zone of, I think, 170, 180 for quite some time, and the stock has done exceptionally well post that. But then on the short-term charts in the last 1-2 months, we've seen the banking stocks underperform, the PSU banking lot, large cap names like SBI, even the the prominent names like PNB, Bank of Baroda, Canara Bank, etc. These stocks have underperformed, and even the private sector banking stocks have underperformed. So I probably believe that we are into that sector rotation phase where potentially these private sector banking names in the PSU banking lot are getting into a zone where there is profit booking or there is trimming of long positions shifting on to the other sectors. And my sense is that if these stocks say correct by a margin of 20% broadly, 15 to 20% from their June-July swing highs, that could potentially be a point where traders could look at a contra buy.
Okay, that's that on banking. In the meantime, of course, technology is the one which is gaining ground, and pharma as well. Anshul, wanted to get your thoughts in here. I mean, of course, it's a very niche space. No two companies are similar, but we've seen a fair amount of rebound play out in pharma. Anything that looks good to you?
Pharma is an interesting space, Aisha, just now, because what's happened is that for the last nearly 10 years, we've had a one-way and down decline in prices of pharma generics from India being exported to the US. Now, that's led to a situation where it's really not remunerative for Indian companies to manufacture many of these drugs. And so there are shortages on US racks of Indian generic pharma goods. And as a result, they're allowing for some stabilization in prices. Combined with that, we are seeing US FDA being slightly lenient and Indian facilities coming on board. Both these things bode well for Indian pharma exporting to the US. In any case, pharma companies which were selling within the country, they hadn't seen any stoppage in terms of demand. So that demand was always very strong. If you look at this whole thing as a combine, it looks like pharma is very interesting, having consolidated for the better part of nearly 7 to 8 years. It's really turning around now in terms of valuations. And in our judgment, this has further legs. Also, geopolitics has a play in this, given that people want to move away from China. Particularly on the CRAM space, India becomes a very interesting market because we have the know-how, we have the capability, and we have the scale to cater to the US markets on contract research. So overall, pharma looks an interesting opportunity at this time, more so because the rest of the market is expensive at the moment.
Pharma does look like an interesting opportunity, especially the comfort on valuation front. But valuation is something which is not very comforting for some of the MNC plays. But given the fact that the Indian markets have been seeing this gush of liquidity and have been doing quite well, some of the global players are looking at cashing in to the Indian markets as well and are using it, for listing some of these, companies and subsidiaries in India and unlocking value. Let me take it across to my colleague Anurag and get more details on this story. Hi, Anurag.
Hyundai Motor India, which in June had filed a draft red herring prospectus, which is a draft of a document for an IPO with the Securities and Exchange Board of India. LG Electronics is considering an IPO for its India business, and this comes months after Maruti Suzuki's market value being more than that of its parent, more than double that of Suzuki Motor Company. Hyundai Motor India's IPO may be a precursor for more global firms looking to list their Indian subsidiaries. Now the rationale for this is that many of these companies have been in India for decades and they are looking to unlock the value and they are looking to strike a valuation. And if you look at the reasoning also
there, but we have a big guest joining us on ET now, and this is the first interaction of the new SBI chair, Mr. C.S. Shetty, in conversation with my colleague Ankur Sharma.
So that it becomes a plug-and-play model. And once all these fintechs we start to work on, there are a lot of side services, niche services which fintechs bring. And we want to give that experience to the customer without actually having to build everything ourselves. Because our earlier philosophy was building everything ourselves. But that is no longer the case. We realize that many of these services are not necessarily for all times to come. They are currently niche, currently in demand, but maybe over time customers may not want them. So we want to quickly launch them, see how the customer reaction is, and if they work out, fine. Otherwise, we can then move on to another service. So this can only work with partnerships. We can't really build everything and see it fail.
One of the innovation, I would say, or new trial was operational subsidiary, which SBI thought of. How is that working out? Is it giving you the desired result which you wanted?
So it's a work in progress. It's a subsidiary which is working like a business correspondent. That's the same kind of license it has been given. The start has been really good because we started off with this in the rural and semi-urban areas. And it really helped us in the agriculture space because many of our branches in the rural area do not have a lot of people. They are essentially single officer branches and they can't really go out all the time. So this is our outbound person who goes out to the home of the customer, gets the necessary documents, helps them fill the forms, brings it back to the bank, helps the account being opened or a Kisan credit card getting serviced and renewed. So a lot of those services have already been started and these people are essentially local people. So they know the language, they know the local people. So I think it's a very new model which we have tried. This is not something we have done. As you know, our general staff, employees, all India, it's hired across India based on exam. So this is a new model and hopefully this will help us to give the doorstep service, help with the small ticket servicing, the bottom of the pyramid, And as we move along, maybe move on to recovery and multiple other services which any customer or any segment requires.
Right. One of the problems which banks were facing recently is the deposit side. Now, State Bank of India being such a larger base, what is your view in that? Is it there going to be any impact on the margins which you think you will also feel a similar kind of pressure?
So there are 2-3 things. One is that this is a fact that for the last 26 months, that is slightly more than 2 years, the deposit growth has lagged credit growth. This is the actual data. And there are many banks which have CD ratios either close to 100 or above 100 or definitely between 85 and 100. Now, as far as we are concerned, we are still marginally short of 70. So we might exceed 70 this quarter, but around 70, let's say. So therefore, we have some way to go, whereby we already have excess SLRs and we are using that to actually lend more. But the pressure on deposit rates is clearly there. And as the deposit rates increase because the demand for higher rates is there and every bank is trying to raise deposits, there is clearly this pressure on the margins, because on the loan side, we are probably at the peak of the interest rates. They are not going to go up from here on. And yet the competition is such that people are quoting very, very low rates. And this is something I think our chairman has been on record to say that we should not give loans at rates which are not economically viable. So one can understand once in a while, but it cannot be a general trend that we will give out loans, and we have been trying to resist this trend. But this is the market, this is the competition, and therefore a combination of lower and competitive rates on the loan side and a higher rate on the deposit side clearly puts a pressure on margins. This is true for industry, which is true for us as well.
Can we expect the credit growth target to be revised considering the growth scenario which has been there?
We haven't revised it so far. We have been giving this guidance of 14 to 16 for a long time, and actually doing more than that. So what we saw in the last one quarter and the previous year was our agri, our SME, our large corporate, all of them have grown around 20-18%. The unsecured portion and the housing loans actually has come down. Housing loan is around 12, and unsecured is also a lower number. So clearly the demand from the economy for productive sectors is quite high, and as long as that is there, I think we would want to support that demand, and whatever liabilities or whichever shade of liabilities we have to raise to do that, we will do that.
Okay, so that was Mr. Tiwari of SBI talking about the way forward for the bank. An important one is, nonetheless, we were hoping that perhaps Mr. Sethi will also be speaking at the GFF and to ET Now shortly. But that was Mr. Tiwari, the MD at SBI, talking to us about the way forward and how the entire financial sector is poised for growth right now. But shifting focus to what's happening in the market, and in the last few minutes, there has been a bit of a perk up on Vedant Fashions. We have stopped talking about the stock. Has been a rank underperformer since its listing itself. So just watching out for that. GSPL is the other one. Off late, we have seen good traction, and today as well, that stock has managed to perk up. On the losing side, V-Guard has taken a bit of a knock. Let's pull up the intraday chart of V-Guard if that's the right rate for me on the screen, because that's showing quite a bit of decline. No, it's down just about 2% only right now. But coming back to the markets and the key stocks and sectors which have been in focus, just wanted to get a better sense from you, Anshul, regarding some of these real estate stocks, because there's a bull versus bear case kind of scenario building up on those. Part of the street believes that the peak is over, and we have seen the best with respect to the stock prices as well. But some believe that it's going to be a long drawn cycle, and there's still a case to continue holding some of the real estate names. Your take?
Hi, Anisha. So on real estate, there is definitely a lot of positive price action which has played out over the last 3 years. And that is obviously because of on-ground activity which has been favorable. But going forward, while the premium segment of the real estate market has done very well, the less than premium segment has really not done too well over this period. If consumption in the country, if investment in that space is to pick up, then it is this category which has to come in and play its part. So while you may see some stocks which are more premium, or some companies which are more premium in their offerings, those companies kind of stagnating, But in our judgment, the sub-premium segment in real estate has significant legs. And with the sector having cleaned up over the last 10 years, that opportunity still remains. Volumes in that space should pick up. And that is a space which is not so linked to the equity markets. It's more linked to actual end consumer demand. And as that demand picks up, we do believe that volumes there should pick up going forward. So real estate, I don't think that it is a sector which you can see with one lens. It is a sector which has various segments. Some segments may stagnate, as you rightly said, but there will be segments in this space which will do very well. And so identifying the right opportunities here is really the game going forward.
Okay, identifying the opportunities, that's something that one needs to do. Kunal, but what about the opportunities in the auto pack? We're just at the cusp of the end of the month, and if you go by the Goldman Sachs data, it looks like August is going to be a bit of a soft month because we haven't seen a massive pickup in any of the sales, even though the launches have been something which has got the street excited. Anything on the stock price that gets you excited?
I think Ashok Leyland is the only stock which is looking attractive. Bajaj Auto has done reasonably well, crossing levels of 10,000 mark and then sustaining at closer to those 10,000 plus levels. I think out of the rest of the pack, many of the other names, they have had false starts for themselves, but nothing major in terms of the trend pickup for many of these stocks, whether it's the likes of Hero MotoCorp, which is now getting into a stagnation kind of a zone. Aisha Motors, I think, has been at 48, 49.50 odd mark for the last 1 or 2 weeks, and that stock is also showing signs of more of a range movement. And I think, the likes of Maruti, for example, that stock has had a very strong breakout above the 10,000 plus mark. But then at 11,500, 12,500 range, the stock has been a lot more sideways. So there is literally not major kind of a trend which is picking up in the entire auto pack, and I think that's where one would probably have to be a lot more specific. Ashok Leyland is still at 260 plus levels, which is the one where I would believe that there is still some strong momentum ahead. Would look out for targets in the range of 290 to 320 for Ashok Leyland over the 1 to 3 months. But most of the other pack would just be more of trading bets rather than any kind of a positional bets.
Right. Okay, that's the take coming in on autos right now. In the meantime, let's also address what's actually on the losing end. And sure enough, it's Asian Paints, there's Adani Enterprises, Maruti, Axis Bank, SBI is also a laggard, as is the case with ICICI Bank. That's also just mildly soft in trade right now. In fact, there's Adani Enterprises too, which is down about almost 1.5%. You're seeing Nestle, Ultratech Cement, L&T, which is also lower by about almost 0.5% as we speak right now. Anshul, what's the broad messaging though? Whether or not to even put fresh money to work at this juncture in the market, given the kind of valuations and the run-up we've already had or not?
Aisha, the markets are trading at 20 times price to earnings on FY26 numbers. This is Nifty estimates. Small cap index is also around the same level. And the mid cap index is in a different orbit altogether, over 30 times price to earnings. Now, in this sort of a market, unless you're a seasoned investor who can identify opportunities which are still cheap, it becomes very difficult to identify reasonably priced opportunities where the margin of safety is high. So if your portfolio is like 70-80% in equities, this is not the time to add more to equities because by and large, the markets are fully priced. But if your portfolio is say 20-30% equities and you've mostly missed the rally, then adding some to the markets and that too to quality names, large caps, more liquid names is a better strategy than not. Also because in that space, if you do see corrections, you'll have the heart to go in and invest further because markets have come off, names are well researched, good companies, you'll be able to add more to those names. But putting new monies in spaces which have done well recently and where you are chasing returns is a fool's paradise. In fact, it is that space where you will really burn yourself again and then be out of the markets for the next 4 or 5 years and then come back again when the markets are at peaks. So, that is really not the space one should be looking at this time. But I can, despite my saying this, I know that most people will still look at that space. It is really Nifty 50 and the large caps where you have relative value at this time as regards, various segments of the markets. And it is there if you want to put new monies to use, it is there that you should be investing new monies clearly.
That is where you need to invest your money. Thanks so much, Anshul, for making time and speaking with us today. But time to
If you like this video, then like, share and subscribe to ET Now.